Hello, welcome to Tradeonomics.
Trend trading has three types of trends. We call it as an uptrend. We have a downtrend, very obvious to our eyes, and we have something called a sideways trend. What is a sideways trend? Sideways trend is a trend where the prices neither move up nor down. So it's in a kind of a decisive phase where price points reach a level, higher price points reach a level such that it does not allow for further price movements higher. And there are certain price points in the lower level which try to obstruct the price moving further down. So we call these high points or the level which is formed here as the resistance, and the lower range, price range, which does not allow the price to fall further, we call this level as the support. So we see that we have several pivots, minor pivots, major pivot, intermediate pivots formed inside this range. It's neither moving higher nor moving lower than this range, and this kind of trend we call it as sideways trend. How do we trade this sideways trend? That's the most crucial stage for any trader. In an uptrend, you go long, in a downtrend, you go short. But what do you do with the sideways trend? Where do you get here? Which kind of an entry do you take here? Is it a long? Is it a short? Ideally, it's best to avoid the sideways trend and stay out of market. That's what the Trado method says. But can you ignore a sideways trend? No. The sideways trend gives us an alert that the moment there is a breakout, it's going to be a nice long for a trend trader. Or if the sideways trend breaks down, the signal is for more downward movement. Stay connected as we show you some more examples on how we handle a sideways trend and how we take trades post a breakout or a breakdown. This is an hourly chart of Tata Steel. Let's identify the sideways range. With our naked eyes, we can identify this is a sideways range. But how do we identify it with the price points? So let me start marking certain price points which are very prominent and distinctly it shows that it does not let the prices move above this level. So we have this higher points which does not let the price to move above this point, and this is called the resistance area. Now we also have certain price points in the lower range. I'm marking it here, and these 3 points does not let the price fall below this level, and we call this as a support level. So we have a resistance level above and a support level down, and have a look at the pivots which are formed inside this range. These pivots are all formed inside this range and does not have a tendency to either break out nor break down from this range. So let's see what happens if this range is broken, and how do we trade when a breakout of a range happens. In this case it's a breakout, so let's explain that. Have a close look at this candle, which is the first candle in this on that particular day, first hourly candle I should say. So do we take a trade directly at the price of the breakout of the resistance level? Well, that's not the ideal situation, because you just have a look. If you are a swing trader, you have to go by the 60 minutes chart, and if you're a swing trader, you take a trade here, you enter here, and you're waiting for a pivot to make to keep a stop loss, and your pivot will be here. This is the stop loss which you're going to place for a swing trader. Well, first, as the prices move up, you're happy that it's gone above 790 levels. But for a swing trader, you have to wait for an exit again with pivots, hourly pivots. Do you see an hourly pivot happening here? No. Look at the price, it's fallen below our stop loss and your time and you're stopped out. So look at the loss what you incur as a hourly trader if you trade or if you take a entry just at the breakout of a sideways range, and the prices keep falling or more or less again forming another range. Let's see if you are an intraday trader. How does it work? See the 15 minutes chart. How does it look? The 15 minutes chart is this. Do you have an entry here? Well, no, because if you take an entry at again the break of the resistance of the support, resistance of this sideways range, we have again this as the stop loss. The stop loss is somewhere around 760 and your entry is somewhere around 780. So it's like a 20-point stop loss, which is really too high for an intraday trader to digest. So here again we wait for a 15 minutes pivot. Is there a 15 minutes pivot? Well, no. If you are a true intraday trader, you start looking for a smaller time frame. So let's see a 5 minutes trade. How does it look? A 5 minutes chart, does it give you an entry? No. Another no for a no pivot in a 5 minutes chart. Let's move again to a 1 minute chart to see if there is an entry in a 1 minute pivot. Well, there seem to be something like that. Let's just expand and see how it looks. Now, this is the 1 minute chart of that particular day. You have a pivot kind of a situation over here, basically a pullback and let me expand it a little further for you to understand better, because you will be on a live time frame when you trade. So I would like to show you how it looks. So here you can see a pivot kind of a situation. For an advanced trader, he may take it here because it is a pivot according to him. But well, for ideally this is not a pivot, and we will have to take a trade above a pivot, 1 minute pivot, which is clearly well-defined pivot. To understand a pivot, the formation of a pivot, identification of a pivot, you need to read through our course called Teach a Man to Fish, which is available in our website. Also, you can take up our paid courses on intermediate trend trading, which will give you more clarity on identifying a pivot and and a trend. So currently, we consider that the intraday trader takes a long at a 788 level above the 1 minute trade, and he starts following every pivot, and for an advanced trader he may exit at 793 levels. So you have a 788 to 793, a clear 5 points profit for an intraday trader. That's fine, but how about a swing trader? A swing trader will follow an hourly chart, and let me show you again this chart. Let's expand this. Now say if the swing trader takes a trade here, as I told you earlier, he's going to get stopped out. So ideally, a swing trader has to wait for a trade above his hourly pivot to take a long here, or if it's a short, again he has to follow an hourly pivot below the sideways range or below the support levels of the sideways range before he takes a short. So this is the ideal scenario for a positive trade in your direction. Otherwise, most of the trades which are taken at the break of a sideways range or break down or a breakout of a sideways range may end up into a failure, because they can be just a small spike up in a price and then pull back, and that pullback may be really difficult for us to accept. A quick glance of how the risk is involved in a direct trade below or above a sideways trend. So here we are taking a Tata Steel chart again, and we have seen earlier in our examples how we mark the highest points which create resistance lines, resistance levels, and the lowest points, price points, which are forming the support level. So we have now a sideways trend. We can call it as if you're an intraday trader, this becomes a intermediate trend, or if you're a positional trader, this becomes a minor trend. So these things about trend and about the formation of pivot, you can read through in our Teach a Man to Fish course or join our level 1 courses. So have a look at these movements, price movements, and the candles which are playing around in this range. And what as an intraday trader, you short below the support line immediately. Look what has happened. Let's enlarge this and see that this fall below the support line has been sharp with a nice WRB. It has fallen below the support line. But what has happened in the next following 15 minutes candle? It's pulled back. It's pulled back to the extent that I should say it's around a good big loss. So I should say, let's see, around 765 and 775 points of loss is what you have to undergo if you take a trade on a direct below the support line. Similarly, here above the resistance line also, you see it has gone up, and after the two big candles, it has fallen straight back to or rather below the line, below the level. So the art of taking a trade along above the resistance line and a short below support line after a sideways, or we call it a sideways breakout, is very, very crucial, and it can damage your trade and ensure that you're thrown out from the market soon.